The United States stock market is currently closed, and as of the final bell on Wednesday, July 15, 2026 at 4 p.m. Eastern Daylight Time, Ondas Inc., trading under the ticker symbol ONDS on the NASDAQ, finished the regular session down 3.94% at an exact closing price of $7.05 per share. While casual market observers look at this single-day decline as a minor hiccup in a highly volatile micro-cap defense stock, the hidden reality is that big institutions and corporate insiders are executing a massive structural shift behind the scenes that completely turns the prevailing narrative on its head. Mainstream investors look at headline press releases detailing an eye-popping $875 million acquisition of DZY Technologies and assume clear skies ahead. But the real story is found buried deep within a prospectus supplement filed with the regulators, registering over 3.3 million existing common shares for potential resale. This secondary supply is hitting the market without bringing a single dime of fresh cash into the balance sheet of the enterprise, and it highlights a structural vulnerability that most retail portfolios are entirely blind to right now. This massive contrast between public expectation and mathematical reality creates a fascinating backdrop for anybody managing an individual brokerage account or analyzing autonomous defense companies. Many individuals who engage in active self-investing often get caught up in the near-term excitement of a company's product line, without realizing how institutional positioning dictates the long-term trend. When you are looking for investment help on various internet forums, you often see people comparing smaller growth names to giants like Tesla stock, Apple stock, or Nvidia stock, expecting identical multi-bagger returns without analyzing the underlying shares outstanding. This habit of ignoring corporate filings while looking only at a chart can lead to severe capital erosion, especially in volatile market environments where small-cap liquidity can dry up in an instant. The general consensus across mainstream forums and retail channels is that Ondas Inc. is an unstoppable player in the booming counter-drone and autonomous hardware sectors, driven by escalating global defense needs and a recent wave of massive industrial contract bookings. Many retail investors logging into their Robinhood app look at the sheer percentage gains over the past few months and think they are catching a rocket ship early, expecting the stock to immediately blast past its previous 52-week highs. The retail crowd sees a multi-million-dollar backlog, high-profile automated drone deployments, and aggressive revenue guidance updates for 2026, assuming these milestones guarantee immediate share appreciation. This creates a high-conviction expectation that the firm's stock price will mirror the historic performance profiles of primary market leaders, causing people to treat it with the same long-term confidence they might apply to a massive tech firm or high-profile blue-chip assets. They believe that by using modern online investing tools, they can outsmart the institutional asset managers who dominate the trading floors. People frequently flock to popular investing sites searching for the next big runner, hoping to duplicate the monumental historical returns seen in larger technology names. But the underlying mechanics of a micro-cap company are entirely different from established large-cap giants. However, a cold, objective assessment of the underlying financial statements reveals a far more complex reality that challenges this widespread optimism. When you strip away the excitement of massive defense contracts, you discover that the organization is operating with a high-stakes capital structure that relies heavily on equity issuance to fund its aggressive expansion strategy. While retail traders on standard online investment portals applaud the massive headline size of the DZY Technologies deal, institutional analysts utilizing the professional interactive brokers platform are carefully dissecting the math. They see that the acquisition relies heavily on an absolute mountain of fixed equity shares, meaning that recent declines in the underlying stock price have directly eroded the implied value of the transaction, leaving early stakeholders holding a highly volatile asset that requires flawless execution to justify its premium valuation. This structural dilution means that even as top-line revenue forecasts scale up significantly, the actual net profit margins and cash generation per individual share face severe upward resistance. A retail investor executing trades on the basic Robinhood stock trading interface might not appreciate how this dilution changes the long-term valuation model, whereas an institutional allocator using an advanced interactive broker's account will instantly adjust their risk parameters to account for the expanding share float. To understand why this gap between expectation and reality exists, we need to look closely at the recent price action, tracking the daily swings, trading volumes, and institutional behavior that defined this week. After peaking near the $9 range in late June, the tape began to lean distinctly bearish as supply gradually took control of the order books. The massive acquisition news initially triggered an intraday surge of over 6%, but that enthusiasm evaporated almost instantly when the secondary share registration statement hit the wires, sending the stock sliding down past the mid-$7 mark on massive trading volume exceeding 100 million shares. When hundreds of millions of shares change hands in a single session for a small-cap entity, it indicates a fierce battle between retail momentum buyers and institutional sellers who are looking for liquidity windows to exit or hedge their positions. Traders tracking these movements via advanced tools on the interactive broker's trading software noticed that the bid-ask spreads widened considerably during the sell-off, showing that market makers were demanding a high premium to absorb the sudden influx of secondary shares. Anyone observing the tape via the Robinhood Investments platform could see the raw volume spike, but interpreting whether that volume represents long-term accumulation or institutional distribution requires looking deeper into the block trade data. This recent daily volatility is a direct reflection of broader macroeconomic pressures and shifting sector momentum within the entire aerospace and defense ecosystem. As interest rates remain sticky and public market liquidity tightens, speculative growth entities that are not yet consistently generating organic operating cash flow face intense scrutiny from large-scale asset managers. When an institutional investor looks at their broad asset allocation, whether they are managing funds within Schwab Intelligent Portfolios or adjusting positions through sophisticated automated models, they look closely at structural risk profiles. If a company has a price-to-sales ratio that sits dramatically higher than the industry average, it becomes a prime target for short sellers and risk mitigation algorithms the moment broader market indices feel pressure. This is exactly why the massive trading volume we observed this week is so meaningful. It represents a major transfer of ownership from long-term institutional holders who helped fund early acquisitions to shorter-term tactical traders who are playing the daily swings. Portfolios built on self-investing principles must recognize that when a stock experiences this level of institutional churn, it can remain disconnected from its fundamental value for extended periods, driven purely by order flow dynamics and liquidity demands. To fully grasp the corporate identity behind the ticker symbol, it helps to understand what Ondas Inc. actually does and how its core corporate structure evolved over time. Headquartered in West Palm Beach, Florida, the organization operates through two primary segments, Ondas Networks and Ondas Autonomous Systems. The network division focuses on providing secure, private, wide-area wireless broadband networks designed specifically for mission-critical industrial applications like major railroads, electric utilities, and oil and gas infrastructure. Their proprietary software-defined radio platform allows industrial clients to maintain secure communications across massive geographic footprints where standard commercial networks fail. Their Autonomous Systems division, which has drawn the most attention from retail traders using Robinhood stock trading platforms, develops advanced drone-in-a-box solutions and counter-UAS systems designed for site protection, automated data collection, and homeland security operations. By integrating automated aerial robotics with cloud-hosted data processing software, they aim to replace manual security and inspection protocols with fully automated continuous monitoring systems.
Investors tracking the company via SoFi Invest or using the SoFi investing interface frequently focus entirely on the drone segment, as the autonomous systems division generates the highly shareable media clips that drive retail enthusiasm on public discussion boards. Historically, this business model has required massive upfront capital investment, leading to a long record of net losses and heavy cash burn as they built out their technology and acquired smaller robotics firms to expand their product suite. Past earnings reports show a consistent pattern where high gross margins on paper are offset by massive selling, general, and administrative expenses, alongside heavy research and development costs. For example, looking back at historical quarters, the company repeatedly printed significant operating losses, requiring continuous financing activities to maintain an adequate liquidity buffer. While their recent balance sheet showed a substantial cash position, much of that capital is tied up in complex structural items and